brief on stagflation. It's the scary economic buzzword of the moment, and we're going to cut through the panic to uncover what it actually means for our wallets and the global economy. First, let's break down this ultimate economic catch-22. It hits when three warning lights flash: high inflation, increasing unemployment, and slow economic growth. Fixing it is like trying to put out a kitchen fire by flooding your entire house. Raising interest rates fights inflation but crushes employment, while printing money boosts growth but sends prices soaring. Now that we know what the monster looks like, are we standing face to face with it right now? Second, let's compare the capital S 1970s stagflation to today's lowercase s risk. Back then, we saw double-digit inflation, contracting GDP, and 8% unemployment. Today, on paper, GDP looks decent, but can we actually trust these numbers? Official jobs data gets heavily revised and ignores the massive rise in gig work, underemployment, and folks dropping out of the labor force entirely. If the official data is masking the true pain in our wallets, what's the actual root cause driving this pressure? Finally, the real driver is supply, not just demand. The 1970s crisis was triggered by massive external supply shocks, like oil prices quadrupling. Today, we face the exact same structural issues: inflation driven by supply shortages in oil, gas, fertilizer, and wheat. Think about it. If our prices are rising because of global supply chain shortages, why do central banks keep trying to fix the problem just by tweaking domestic interest rates? While we aren't in a full 1970s tailspin yet, dodging the stagflation trap absolutely requires fixing real-world supply chains, not just moving numbers around on a spreadsheet.